Did you know that a single jumbo jet can cost over $400 million? And companies don't just expense that on day one? That one purchase decision shapes a company's financial statements for decades. If you've ever wondered how businesses handle their biggest, most expensive assets, you're in the right place. In this video, we're breaking down long-term assets in financial accounting. By the end, you'll understand what they are, how they're valued, how depreciation actually works, what happens when you get rid of one, and how intangible assets fit into the picture. Let's get into it. Section 1. What are long-term assets? Long-term assets, sometimes called non-current assets or fixed assets, are resources a company owns that it expects to use for more than 1 year. Think about a delivery company. Their trucks, warehouses, computer systems, even their brand name. Those are all long-term assets. They're not buying these things to resell them. They're using them to generate revenue over a long period of time. Now, long-term assets fall into a few categories. You've got tangible assets, things you can physically touch, like land, buildings, and equipment. Then you've got intangible assets, things you can't touch but still have real value, like patents, trademarks, and goodwill. We'll talk about intangibles in more detail later. Here's the key idea, though. Because these assets are used over multiple years, the cost of acquiring them needs to be spread out over time. That process has a name, and it's probably one you've heard before. We'll get to it in just a moment. Section 2. Determining the cost of a long-term asset. Before we can spread out the cost of an asset, we need to know what that cost actually is. And this is where a lot of students get surprised, because the purchase price is just the starting point. In accounting, the cost of a long-term asset includes everything you paid to get that asset ready for its intended use. So if a company buys a piece of manufacturing equipment, the cost includes the purchase price, yes, but also shipping fees, installation costs, testing costs, even legal fees tied to the purchase. All of those get bundled together into what we call the asset's capitalized cost. Why does this matter? Because that total number becomes the basis for everything going forward: how we depreciate it, how we record it on the balance sheet, and how we calculate gain or loss when we eventually sell it. There's also an important distinction here between capital expenditures and revenue expenditures. A capital expenditure adds value or extends the life of the asset, like adding a new wing to a building. That gets capitalized, meaning it's added to the asset's value on the balance sheet. A revenue expenditure is a routine maintenance cost, like painting the walls or replacing a light bulb. That gets expensed immediately. Getting this distinction right is critical, because misclassifying these affects both the balance sheet and the income statement. So now we know what an asset costs. But how do companies account for the fact that most assets wear out over time? That brings us to depreciation. Section 3. Depreciation methods. Depreciation is the process of systematically allocating the cost of a tangible long-term asset over its useful life. The idea is that the asset helps generate revenue over many years, so its cost should be matched to those years as an expense. This is the matching principle in action. There are 3 main depreciation methods you need to know. The first is straight-line depreciation. This is the simplest. You take the cost of the asset, subtract its salvage value, and divide by the number of years of useful life. Same expense every single year. Easy to calculate and very commonly used. The second method is declining balance, specifically double declining balance. This one is an accelerated method. You recognize more depreciation expense in the early years and less in the later years. Companies might prefer this when an asset loses value faster early on, like technology or vehicles. The third method is units of production. Instead of time, this method ties depreciation to actual usage. How many miles driven? How many units manufactured? It's great for assets whose wear directly depends on how much they're used. Each method gives you a different depreciation expense each year. But here's the thing. The total depreciation over the asset's life is always the same. The method just changes the timing. And timing in accounting? It has a massive impact on reported profits. You might be wondering, what happens when you're finally done with an asset? We'll answer that next. Section 4. Disposing of long-term assets. At some point, every long-term asset leaves the company. Maybe it's sold, traded in, or simply retired. When that happens, the company has to remove the asset from its books and account for any gain or loss on the disposal. Here's how it works. At the time of disposal, the asset's book value is its original cost minus accumulated depreciation. That's all the depreciation charged against it over the years. If the company sells the asset for more than its book value, there's a gain. If it sells for less, there's a loss. Both of these show up on the income statement. Let's say a company bought a truck for $50,000, depreciated it down to a book value of $15,000, and then sold it for $20,000. That's a gain of $5,000. Simple, right? But if they only got $10,000 for it, that's a loss of $5,000. Companies also sometimes retire assets with no sale at all, just taking them out of service. In that case, if there's any remaining book value, it becomes a loss. Properly recording disposals keeps the balance sheet clean and accurate. Now, what about assets you can't physically touch at all? Section 5. Intangible assets and goodwill. Intangible assets are non-physical assets that still provide long-term economic value. Patents give a company the exclusive right to produce a product. Copyrights protect creative works. Trademarks protect brand identity. Franchises grant operating rights. These are real assets with real value. They just don't have a physical form. Intangible assets with a finite useful life, like patents, are amortized, which is basically the intangible version of depreciation. Straight line is almost always used here. But some intangibles, like trademarks, can have an indefinite life and aren't amortized. Instead, they're tested annually for impairment to make sure they still hold their recorded value. Then there's goodwill, one of the most talked about and misunderstood items in accounting. Goodwill only appears on the balance sheet when one company buys another for more than the fair value of its net assets. That premium, the extra you paid, is goodwill. It represents things like brand reputation, customer loyalty, and skilled employees. Goodwill is not amortized, but it is tested for impairment every year. And that, right there, wraps up everything you need to know about long-term assets in financial accounting. Let's do a quick recap. Long-term assets are resources used over more than 1 year. Their cost includes everything needed to get them ready for use. They're depreciated using straight-line, declining balance, or units of production methods. When disposed of, any difference between sale price and book value is a gain or loss. And intangibles, including goodwill, follow their own specific rules. If this video helped you, do me a favor, hit the like button right now. It genuinely helps this channel reach more students who need it. Subscribe so you don't miss the next chapter breakdown. And drop a comment below with your biggest question about long-term assets. I read every single one. See you in the next video.